Assalamu alaikum. Welcome to the first ever lecture of financial management on my YouTube channel. Yes, before this, I've covered the P level subjects on my channel. So, the lectures that I've covered are for AAA, AFM, SBL, SBR. Now, I'm going to upload lectures on financial management for September 2023 paper based on the request that I've got from you people. So I've decided to go for financial management. I'm currently doing ATX and taxation as well, and also financial management. This is the first lecture and also the first topic in your financial management syllabus. Okay, but before I start this lecture, let me talk about few things that are very important. The syllabus of financial management, you can download it from your ACCA website, okay, or you can get it here. The link is given in the description of the syllabus. I've already covered the changes in the syllabus and also the full syllabus of financial management in detail in my previous video. The link is given in the description, and also at the end of the video you will be able to get the uh, syllabus of financial management. So I've completed the syllabus of financial management already. I'm not going to take time to go through the syllabus again. I'm directly going to jump into the first lecture of your financial management. Now, financial management is a applied skill level paper in your ACCA. Okay, and if someone have taken AFM, they know clearly that there is a link between your financial management and advanced financial management, which some of you might plan to take when you go to the P levels. Okay, so they are very much related. Okay, and in future, if you are planning to go in the finance role or you are opting for advanced financial management, then you need to be very good in financial management, because 95% of the syllabus of financial management is tested in AFM. The difference is there it will be more detailed and more advanced. Also, the way the questions will be asked are different there. Okay, there we have to write a report of 50 marks. We have professional skill marks. Basically, we have to type long answers with no objective test questions and all, no objective case questions. But here, since this is level 2 applied skill level paper, we have this paper is divided into three sections: section A, section B, section C. I've already covered this before, but in case some of you might have missed that video, I'm repeating this again. Okay, so section A is objective test question, where you'll be given options and you have to select. Or sometimes you might be given one box, you have to calculate or write the correct answer. Or they might give you some statements. You might have to choose the correct statement or the false statement, like that. Then section B is objective case questions, where case study will be given. Based on that, questions will be given. Okay, I think 2 case studies will be given, and based on that, questions will be given. 4-5 questions will be given. Question C, which is the challenging one and the tougher one also, is you have to write. Okay, it is the constructed questions, detailed questions you have to write, like an essay type question. Okay, so in your syllabus, this is the first, that is section A. Okay, this syllabus is divided into 6 to 7 areas. First area is section A, that is financial management function, and coincidentally the chapter is also financial management function. So this lecture will complete section A entirely. One lecture, section A is over. Okay, rather than breaking this down into many pieces, I could have done that, but then it becomes very difficult for students to manage. Okay, they might not able to get other parts, some will be there, some might be there. So it's, even though this video is going to be a little bit lengthier, but it's good in a way because everything is under one video. So section A is entirely covered in this. Next lecture, lecture 2, will be focusing on section B straight away, that is financial management environment. And a lot of your section A questions you can expect from this area, this topic. That is this lecture 1. Okay, and this is mostly theory, okay, not calculation. There are calculations, not so much, not in detail, not like your risk management or investment appraisal, that which we are going to cover later on, or working capital management. So here we are going to discuss a few things. Now, 4 areas we are going to touch on this lecture. First one, role of financial management. We all need to know what is the role of financial management, because you are taking that subject. You have to know what financial management is, what are the roles. Second, corporate objectives, financial objectives, and corporate strategy. They are 3 different things, but how they are linked. Then, conflicts of interest. This is about stakeholders and all. And syllabus coverage. So the last one is, what are the things that you have to cover in your syllabus? Like after the end of each lecture, there are some questions which you should answer. You should know where you stand. If you are able to answer those questions, you can be sure, confident that you have covered the syllabus. And another way to test is straight away go to your revision kit and do questions. And summary of the topic that will be discussing in this lecture will be provided again at the end of the video. And technical articles that one must read on that particular topic. For example, this is financial management function. So we'll see whether we have any technical articles on that or not. So to know all this, you have to see this video till the end. And this pattern is going to be repeated for the other lectures as well. Since this is the introductory video, the first lecture, I'm taking a little bit time to introduce you to the subject. And also I'm introducing you to the way how I'm going to teach you. Okay. So my way of teaching is I'll be uploading lecture, you watch the lecture and you do the questions. I will not be able to solve questions for this September session, but definitely I promise you for December, I am going to, from September onwards, I'm going to start questions also on financial management. The way I have done for SBR and AFM. In case if you don't know my way of teaching or how questions are solved, you can go back to my playlist and check the SBR revision kit solutions and AFM revision kit solution. The same way I'm going to do for financial management as well. Now, one more thing and very important announcement I have to make. Where did I get these resources from? I have taken 100% of this resource that I'm using on my slides from the ACCA Study Hub. Yes, you must have heard about it. It has been just introduced in the 1st of July. ACCA Student Hub provides all the relevant topics. Chapters are there, questions are there, flashcards are there, quizzes are there. So take some time out of your busy schedule, go there, do the questions after you finish the topic and also the quizzes. And if you want, you can go through the flashcards. I've not uploaded a video on the ACCA Study Hub yet, but there are many videos out there. Do watch them out. And I promise you that I'm going to bring a video on ACCA Study Hub by next week. Okay. And not only for financial management, whatever subject which I'm going to do in the future, all the resources that I'm going to use will be from ACCA Study Hub. The link of those resources will also be given in my description. So when you go to my description, you'll be able to get to the page. And also you can, by using your ACCA credentials, you can log in and you yourself can access those. Because earlier the pattern was I have been using Kaplan textbook, study textbook, this online textbook. But I create slides and then not that directly I don't go to the textbook. The important things I take and make slides and then I explain. So here ACCA have made my work very easy. Everything is there. Everyone have access to it. So now we don't have to go through that hurdle to get the textbook and wait till we get the textbook. And some of you might have this question that, ma'am, should we not buy Kaplan VPP because we are so used to it? And plus another advantage is that anytime we can go back and read it. But the problem with ACCA Study Hub is you cannot download it. So that's why I thought, why not to make slides out of it, so that at least you can store my slide, and whenever you want you can read them, or you can get a printout or anything, you can share it with someone else. But in your ACCA study hub it becomes difficult, you can only view it. You yourself only can view it. Sharing and then you cannot save it becomes very difficult, because I know I have been there, I have been a student. So studying online and suddenly a drastic change from from books to purely online is a little bit difficult, takes time. But no worries, you have my resources, my slides. This PPT slides you can download from my channel. All these PPT slides will be given on my channel. The only step you need to do is go to the about section of my channel, go down and click FM lecture slides or FM lecture. You click there and you will get all this slide. Okay, the day I upload a lecture, the slides will be there. So you can download the slide. Okay, so let's start with our very favorite subject, financial management. And let me tell you about myself a bit, since some of you will be very new to financial management and new to this channel also. So you might want to know my credentials. Okay, I should be a trustworthy person before you can trust me, right? Because there are so many other tutors there on YouTube offering this subject. So I'm Sabi Akhtar, and I have a bachelor degree in accounting and finance, as well as I'm an SSC affiliate, going to be an SSC member soon in few months, and I have been a prize winner for advanced financial management, that is AFM. I have got, because of my bachelor degree, I have got exemptions in the first 9 papers. So that means I didn't had to do the financial management subject, but I scored pretty good enough in my bachelor degree in financial management. You can say I scored in 90s, okay? Something in 90s I scored. And also in AFM I was a prize winner in 2019-20. Okay? So as you can see from the knowledge that I've gained and the subjects that I've taken, I have a very sound and strong background in finance. So that makes me an appropriate person and also a person in authority to teach you finance, whether it is AFM or FM. And also, do go back and check on my Instagram from my stories and the highlights, the AFM stories that I've posted. A lot of people have been a prize winner for AFM. Not only AFM, I have also taught SBR, ATX, ATX I'm currently teaching, and SBL AAA. So students have been prize winner for SBR and AFM. Just through my channel, they used to watch my lecture A to Z, okay, from first to last, and then they used to do revision kit questions, which they used to show me, I used to solve, and I used to give my feedback. I don't used to mark, or now I give one-to-one classes. It's not possible for me with the number of subjects that I do per day. Okay, I do multiple subjects. Okay, I have to keep switching from this subject to that subject. Even now, right now, I'm doing that, from this to tax and then advanced taxation. So I don't get time to teach one-to-one. In case I know after this video you will be sending me mail, so let me tell you that, clear your doubt, I don't give one-to-one classes. I only upload pre-recorded lectures on YouTube. Currently, that is my current plan. Later on in future, I might start with one-to-one class, and whenever I do that, I will let you know. Okay, so if you are planning to ask me through email to give you the textbook, I'm sorry, I don't have the latest textbook. No, I require one. Currently, since ACCA Study Hub, I have released all the lecture, I mean all the chapters and everything. So I'm taking everything from ACCA Study Hub. So I'm not using anything of Kaplan or PPP here, and I don't have the latest textbook nor the kit. But this are taken from ACCA Study Hub, means these are the latest. Till June 2024 you will be able to use this lecture. If there is not any change in syllabus in the next year, again you can use till the syllabus changes. Even if the syllabus changes, it changes only in small places. Financial management, good thing is it does syllabus does not change drastically, like SBR or ATF, like tax or financial reporting. This subject does not change so much, so it's a good thing. And already I've spoke about the changes in the syllabus. That is the only thing that has been added are green finance, sustainability issues and all. That I will cover in the next lecture, lecture 2. Other than that, entire syllabus of financial management is same as the previous year. Okay, so now let's start with the lecture. This is an overview that we are going to go through in this lecture. Okay, first is role of financial management. Under that, what is the nature and purpose of financial management and the relationship of this with financial and management accounting. Okay, you have previously done those two subjects. Okay, when you come to financial management, it is you have to have some knowledge of your ratios and some formulas, those which have been taught to you in financial and management accounting. Even if you have come through exemptions, like suppose some people get the first 3 paper or first 4 paper exemptions, and then they come to the applied skill level and assume first paper is financial management, still you will be able to do financial management. I can bet you that you don't have to go back and study those subjects, not needed, even with exemptions, because the biggest example in front of you is me. I am an exempted student. I have been exempted all the 9 level, and directly I have joined the P level paper. So when I started with AFM, I didn't have that issue that because I didn't cover financial management in ACC, I didn't face that issue in AFM, because subject wise everything is same. Only the way is the questions style is different and all those things. Anyway, coming back to this, next, objectives and strategy. What is strategy? What is corporate objective, financial objective, non-profit organization, and environmental issue? Then conflict of interest, agency theory, stakeholder, directors and shareholders, the reward scheme, corporate governance. Majority of this, okay, especially that conflict of interest part, is covered in detail in SBL. If you have done SBL, I mean, I'm usually it does not happen that people give P level before F level, right? So whenever you give SBL, you will study this again there in detail. Okay, but even you don't have to wait for SBL. You must have covered this in your previous papers. Okay, in your accountant and business and that paper, the F1 paper, majority of the portion you have covered. Okay, now what is the objective? Objective of the financial management is you have to appreciate various stakeholders, okay, and their respective objective. First, you should know the nature of financial management and how you are going to work with the other stakeholders and manage their objectives, because your objective and the other stakeholders objectives are going to differ. How you manage is what we are going to study in here. Now, what is the nature and purpose of financial management? Financial management, see all these words and all, okay, you need to be very very sure of each word, because in your question section A, objective test questions, they will give you 4 options, or they might say which of this is incorrect, which of this is not a function of financial management. For example, a question might come like that. So for that, you should appropriately know the functions of financial management. Word by word you have to know. Okay, so financial management, okay, is how you manage activity, how you efficiently use your resources or acquire resources, and use short and long-term financial resources. I repeat, how you manage the activity with the efficient acquisition using short and long-term financial resources. Now, in your financial management, this is the same thing in AFM also, okay? 3 key decisions are there. That is investing, financing, and dividend. Remember this 3. That's why I've made it highlighted for you. So the 3 key decisions are investing, financing, dividend policy. They differ. They differ. Specifically, these are some key decisions that a financial manager needs to know. For example, if you are in a position of a financial manager, you should be knowing how and how much, in what form, and how much capital should be raised. Are you going to take debt or equity, and how much? Next, how much fund should be raised? That we have answered. Third, which investments should be selected, or how the fund should be raised for an investment. Then, how much dividend should be paid to the shareholder? That is dividend decision. How much working capital should the organization have and how should it be financed? And how should the risk be managed? In fact, if you see this breakdown of this is our previous, our later chapters are going to be on this only. For example, we have a whole section on risk management, which is a job of a financial manager. We have a whole section on working capital. We have a whole section on dividend. We have a whole section on investment appraisal. We have a whole section on even financing. So you see, it is interlinked with your other parts of the syllabus. Now, these decisions are interrelated. If you are having a decision on one area, it is going to affect on the other area. We'll see how. If you plan to increase the dividend, that is a dividend decision. Okay, but then you will not have the amount of cash, okay, that is retained. Therefore, you need more finance now to invest. You need more fund, that is financing decision, to invest, investment decision. So if you increase dividend, you need more of finance to increase your investment. Next, if you decide to invest more, that is investment decision, no? You need more finance also. So financing decision. Then your dividends will reduce, especially if you are taking retained earnings to finance your investment. Then how can you pay dividends? You pay dividends from your retained earnings, no? So dividend will reduce. Now, relationship with financial and management accounting. Okay. Now, financial accounting, we know what is financial accounting. We record the transactions, right? All the transactions we record, debit, credit, that we know. So financial accounting will have an influence in financial management also. For example, okay, directors of quoted companies, they need to consider the effect of financing decisions on the published financial statements. Who produce financial statement? It is not the role of the financial management. Financial accountant does that. They prepare financial statements. But if you are a director of a quoted company, then how you finance, your financing decision is going to have an impact on the financial statement. Example, if there is any lease that is more than 12 months, what happens? Lease is a part of financial accounting. But how it will have an impact on financial management? It will increase financial gearing. Financial gearing is a part of financial management. Financial gearing means debt is more. It becomes very risky. Gearing going up above a certain percentage is not good. Okay. Gearing means you are using more debt than equity. Debt is more in that than equity. Now, directors of a quoted company, the next example, second example, directors of quoted company have to see the effect of the investment decisions on some key ratios. For example, return on capital employed. Return on capital employed were calculated by financial accountant, but that might increase or decrease based on investment decisions that financial manager takes. Now you see, can you see the connection? So it affects. Next is with the management accountant. There also there is a link with the financial manager. We'll see how. First example, budget. The budgeting process may identify cash deficits and surplus, right? When you do a budget, budgeting we have covered in performance management. We identify deficit or surplus. So through that, financial manager can then plan how much finance they need, whether they need debt, whether they need an overdraft in advance, whether they have enough cash surplus to invest. Next, management accountant, what do? They divide fixed cost and variable cost. This will help the financial management to take decisions. And third, variance analysis. Variance analysis are done by management accounting department. This will help the financial manager to control the cost of new project, because who invests in new projects and all? It's the financial manager. Okay. Now we are coming to the second part of this lecture. First part is over. Role and function of financial management. Now, the strategy. Strategy, we all know definition is long-term plan to achieve our objective. Okay. Now, corporate strategy is, it is for the whole organization. Okay, strategy for the whole organization. Corporate objective. Okay. Now, company have varieties of this corporate objectives. For example, objective like profit target, they might want to increase the profit up to a certain percentage, or market share target, share price growth, local environmental concern, contented workforce, they want to satisfy their workforce, or meeting short-term targets. You must have heard about this. Profit target, sales target, keeping the staff loyal and happy. These are corporate objectives. Now, and also some long-term plan also might be there. Now, we can classify this objective. First set of objective is profit goal. Anything that increases profit is known as profit goals objective. For example, if your goal is to reduce cost, it will help you to increase profit. So it's a profit goal. Next set is surrogate profit goal. Surrogate means directly it will not increase profit. Those objectives will indirectly increase profit. How? For example, if you maintain a contented workforce, if you keep your workforce happy, indirectly your profit will increase. Third, constraint on profit. Anything that reduces profit. That is, for example, if your objective is to not harm the environment, you will not be able to increase your profit. It will be restricted to some level. That is known as satisfying profit. Next, dysfunctional goal. This does not give any benefit. For example, a company might have a goal to be a market leadership at all cost. All the cost you want to be at top. It's not possible. So now, company can do two things. Either they can maximize their objective, or they can satisfy. Satisfies means they stay content with whatever they have. Okay, whatever amount they have. It's not too much, it's not too less, it's moderate amount. Okay, so maximizing means it's the best outcome they will seek, and satisfying is adequate outcome, somewhere moderate, not too less, not too much. Now, next is financial objective. Financial objective, whenever you see the word financial next to the objective, make sure that it is something to be calculated. Some numbers are attached to it because it's financial objective. For example, objectives like earnings per share, dividend per share, gearing level, operating profit. These are financial objectives. There are three main objectives. First, maximization of shareholder wealth. This is the foundation of our financial management also. Our financial management decisions are based on this prime objective. That is maximization of shareholders wealth. Anything that maximizes shareholders wealth. Why? Because it is believed that anything that maximizes shareholders wealth brings you cash. We are not so much worried about profit, it's cash, because every business thrives on cash only. At the end of the day, we need cash. Okay, profit is an accounting figure, you can manipulate, but cash is what we need cash coming in. For example, why do we manage risk? Why do we invest in profitable projects? Why do we manage working capital? To maximize shareholders wealth. But how do we manage working capital? How do we manage risk? How do we invest? To know those only, we have those appropriate subjects, I mean those sections in our syllabus, which we are going to cover later on. Okay, second objective, profit maximization, and third, earnings per share growth. 2 and number 3 are substitute for the first one. We'll see how. First one is, it is the single corporate financial objective, the first one. Okay, this how can you measure? This is combination of two things. Okay, shareholders wealth is measured by combination of two things. One is dividend, one is share price growth. When you add them together, it is known as total shareholder return. You have to remember all those things, by the way. Okay, in your exam paper, yes, formulas are there. Yes, the discount table, annuity factor table, present value table, standard normal distribution table is given, but all these things are not given. Maybe some things are given, but not everything. Not all the formulas of ratios not given. You have to know it. Even TSR, this you have to know. So the formula is given here. Okay, that is year-end share price. You'll be given all this. Only thing is you should be able to calculate year-end share price minus share price at the start of the year plus dividend per share divide by share price at the start of the year. Multiply this by 100. That 100 came down, but it is supposed to be multiplying with that fraction only, so that you get it in terms of percentage. Okay. Now you need to know something more about shares. So company shares are usually traded on stock market. Okay. How do we decide shareholders wealth? Shareholders wealth increases when share price increases. Okay. And this happens when company makes good profit, because either they will pay it out as dividend if they make good profit, or they will reinvest it to support future growth, both in the business or in dividends, assuming that those profit was achieved without any risk, business risk or financial risk. This, what is this business risk and financial risk? We are going to study this in detail when we go through our investment appraisal lecture. Okay, for that time being we'll keep it. They're two different things, and it's very interesting topic. Okay, now, so objective of maximizing share price is used as a substitute for maximizing shareholder wealth. So if you maximize share price means you will maximize shareholders wealth. It's like that. Now one example is given. Okay, when dividend has been changed, change in dividend and share price. Okay, here 100 shares has been purchased at the beginning of the year. Market price was 10. Then end of the year, dividend was 1.2 per share. End of the year share price went up to 12.9. You see, before it was 10 market price. Later it went to 12.9. There's an increase in share price. So now this is how, using the formula of TSR, we'll calculate. Old share price, new share price 12.9 minus old share price, that is 10, plus the dividend 1.2, divide by the old share price, that is 10, and multiply by 100, you will get 41%. There is another way of calculating this TSR, this 41%. That is like this. Since we know it is made of two components. First is capital gain, second is dividend. Capital gain means because share price changed, from 10 to 12.9. So first is that gain. How do we calculate that percentage? It is simply the new minus old divided by old. So 12.9 minus 10 divided by 10, which is 29%. Second is dividend yield. So we'll take the dividend divided by the share price at the beginning. So dividend was 10, dividend was 1.2, share price was 10. The old share price, okay, not the new. So 1.2 divided by 10 is 12%. Add 29 and 12, it will add up to 41%. Okay. Now, so this objective of maximization of shareholder wealth can be justified in following ways. First one, company which provides the highest return find it easier to raise new finance also, and also to grow in future. This means they are using their resources to the best capacity that they can use. Optimal resource allocation is there. So this maximizes the overall wealth of the nation also. Shareholders' wealth increases means overall wealth of the nation also increases. Second, companies with the highest return are those usually that provide their customers what they want. So this is also consistent with the nation's economic health also, that you are giving what customers want. So they are also happy, you are also happy. Customers are satisfied with your good, you are getting the highest return. Both are happy, nation is happy. Third, companies that fail to provide adequate returns may become targets for hostile takeover. And directors have a legal duty to run the company on behalf of the shareholder. Okay. So it is a general assumption also that shareholders of a listed company. Okay, they seek to maximize wealth. Now, there are some criticism also. With some good comes bad things. First, okay, they tell maximize shareholders wealth, but it ignores market imperfection. Market is not perfect, right? In reality, market is imperfect. So sometimes it is not good for you to maximize returns, especially if you are a monopoly. Monopoly means single firm is dominating, or one firm having more than 25% share in economy is known as a monopoly. Monopoly is not good for the public interest, not good for the consumers' welfare also, because they might charge too heavy a price. And if it's monopoly, it is going to harm the consumer. Okay. Next, it ignores social needs. There are other needs also other than shareholder wealth, like health, education, and so on. Maximizing TSR, total shareholder return, ignores the interests of other stakeholders. You have to take care of employee, their job, you have to take the customer, they want low price. You have to think of the society also, no pollution. Then, if it's an unlisted company, shareholders will not be required to maximize return because they are happy with what they have. That you can call satisfying profit. Okay, they just want to maintain the company for a lifestyle. Okay, for example, their main objective is just to have that prestige that they're owning a business. That's it. Now, our next objective is profit maximization. In reality, maximizing TSR, total shareholder return, is hard. Why? Because a listed company's share price is not only influenced through your choice, it is affected by many other decisions which is beyond your control. Next, unlisted company does not even have a quoted share price. So how can they maximize? Then, therefore, in practice, this is used as a proxy for shareholder wealth maximization. What is it? Profit maximization. You can take this also to say that it is taken in the place of shareholder wealth maximization. But remember, even if you take it as a proxy, we all know profit is not a good or reliable proxy. Why? Shareholder wealth maximization is a cash based and profit is accounting based. They're two different things. We'll see why it's not reliable. Because, as we told, value of the company's equity is connected with the cash generation. How much cash you generate, not some accrual based accounting profit. Next, management. If you link it with profit, management will think only short term. It is called as tunnel vision. They will, or myopic. Their aim will be to boost short term profit even at the expense of long term gain. For example, they will not invest in research. They will not train the staff, which will be in the future they will give return. Yes, currently it's a cost. Now, third reason why it is not a reliable proxy is excessive pressure to maximize profit can lead to manipulation of data. For example, fraudulent accounting. And we all know the penalties and all those things that comes with it. Then, accounting profit, if you see, they report the debt financing cost. You will see in your profit and loss account the interest expense, right? But what about the equity financing cost? The required return of shareholders, it is not written anywhere. Okay, so you can maximize the profit by using zero debt in the capital structure of the company. But if you maximize that way, remember, you have to pay more tax. If you're purely using equity and not debt, you have to pay more tax because debt has an advantage over equity. That is in the tax. If you are using debt, you have to pay less tax. How? Because in debt you pay an interest, and interest is often deducted from expenses before we pay tax. In short, interest is tax allowable expense, or you can say tax shield. So it gives a benefit. That means you have to pay low tax. But with equity, dividend is often reduced after paying tax, so no benefit. Third objective, earnings per share, EPS growth. The formula for EPS is this: profit after tax minus preference dividend divided by weighted average number of ordinary shares in issue. See, why do we deducted preference dividend from profit after tax? Because that is only the profit that we have to pay our ordinary. Our ordinary shareholders, remember, in the hierarchy, they're always paid the last. They're the risk takers. They are paid after everyone is paid. After you pay the bank their debt or the interest, after you pay the preference dividend, everyone is paid. Equity shareholders are paid at the end. That's why you deduct preference dividend from profit after tax and divide by now ordinary shares. Now, but for preference share have flexibility. It depends on how you classify that, as a non-current liability or as a equity. If preference shares are classified as a non-current liability, that is long-term debt, okay, then this preference dividend is included in the finance cost. How you take debt, okay, because debt is if you take a long-term loan, it's a non-current liability. Same way, on that you pay interest, which comes under finance cost. Same way for preference dividend also, it will be included in finance cost. That means it has already been deducted from the profit, because see the formula, up profit after tax, okay, already you must have deducted that finance cost from profit, so you don't have to deduct again. So profit after tax minus preference dividend, no, if it is classified as non-current liability, already deducted. If it's a equity, then only you deduct preference dividend from profit after tax. Why? Because preference dividend shareholders are paid before ordinary shareholders. Now, this EPS growth is very important for the financial manager, because this tells you about the future. If there's a growth in this, it means there's a good future for them. Okay. So often analysts publish a quarterly forecast for this EPS. They focused that this is going to be the EPS. Quarterly they do this. So this means this puts a pressure on the management that they have to meet whatever the EPS predicted by an analyst. And remember, it is profit after tax minus preference dividend. But whatever it is based on accounting profit. Okay, so EPS, because it is based on accounting profit, it will have all the problems that was there for profit maximization. All those problems, short-term thinking, then profit could be manipulated, window dressing, creative accounting, everything. So go back to profit maximization limitations. Every problem EPS also will have. Addition to those problems, these are the further problems EPS will have. Number one, you can cosmetically boost EPS by undertaking a share consolidation. What is the meaning of it? Cosmetically. See, for example, I will give an example through ladies who go to beauty parlor, right? I know it's not related to the subject, but it is very much, it's a very good example that came to my mind, okay, at this moment. So what do? They put all this cosmetics and everything on your face, and they try to hide all the problems that you might have, right? Your wrinkles, your acne, and if you have dark circle, they will hide it like with concealer and all. So what do? They beautify it, right? They make you look more beautiful than you are. I'm not criticizing anyone's look here, but you understood, right, what I mean to say. So you make them beautify in the eyes of others who is going to see, but that's not the reality. The moment the makeup falls on, that cosmetic goes away, you come back to reality, right? So cosmetically, it's like artificially they do that. It is not something really. They artificially boost that. Okay, they undertake a share. So they, how do they do this? They replace several existing shares with one new share. Okay, now let me ask you a question. This is a little bit of common sense, not to do with finance. Okay, tell me whether if your number of shares increases, your EPS will increase, or if your number of shares reduces, your EPS will increase. If you understood that, you will understand this better. Think to answer this question, you have to think about the formula. Number of ordinary shares comes below in the denominator. So here you have to use maths. Okay, you can pick up any random number, put it there in the fraction, keeping the numerator same, and see the effect, the change. the lower the number in the denominator, the higher your figure, your actual answer. The lower the number in the denominator, that's how it works for anything, any number. Always when your denominator is less, the number will be higher. If your denominator is more, number will go down. There's an inverse proportionate relationship with the denominator and the final answer. I'm not talking about the numerator, what's up. I'm talking about the down part. For example, if let's take 10 and 5. If you divide 10 by 5, answer is 2. But if you divide 10 by 2, answer is 5. So dividing by 5 gives a lower number than dividing by 2. You understanding? So like that, your objective to increase EPS should be to reduce the number of share. So to reduce the number of share, let's say you have several shares, right? So those several shares you replace and you make it one share. Let's say 5 shares, so 5 for 1. Those 5 you combine and make it into one share. So 5 becomes 1. And when you divide something by 1, number becomes bigger, EPS. You understanding now? Now I think you are in a better position to understand this. 5 becomes 1. So like that, artificially, temporarily EPS increases, boosted up, which is not good. I'm not promoting any kind of those activity. Okay, it's unethical. Next, if you don't want to go through an unethical way, legitimately also you can increase your EPS. That is known as share buyback scheme. Share buyback scheme means you buy back your share. Using the surplus cash that you have, you repurchase. And then you cancel part of the share capital. So this reduces your share capital. So if it reduces your share capital, EPS will increase. But this is ethical. Okay, share buyback scheme is there, you can do that. But not the first one. First one is not ethical. It's not legitimate. Okay. But there is a downfall to this. The share buyback scheme. That is, research have proven that often this company directors, they buy back their share for personal gain, not for the company's welfare or to increase EPS. How? Because whenever there's an announcement that someone is going to buy back the shares, share price increases during that time. Don't ask me why, how, and all. For that, you practically need to work on that field, which I don't have experience of, but it is said like that, and you need to believe it, that share price increases during that period where there's an announcement that there's a buyback scheme. So this increases the value of the share for the director through executive share option scheme. Executive share option scheme means directors of the company are given these options that when share price increases or anytime, let's say within 5 years, they hold the share, they can get the shares of the company. So they usually get this buy shares of those company when share price increases, which is good for them, but it's a personal gain. Okay, it's good for them, but the problem is for a company it might be bad. That's the thing. Okay, when they have this kind of schemes, share option scheme, where they have the option to buy they have the option right now, they have not exercised it, but when share price increases they buy back their share. Okay, now not for profit organization, the next one. So here we need to know that objective, which is different from our normal profit organization. Here there are number of different types of organizations like charities or public sector, and also organizations, they are not constrained by the cost profit objective to the same extent as the companies would do, but they are still restricted by multiple stakeholders. Multiple stakeholders have different objective, so it's very difficult to align each objective with the different stakeholder in not for profit organization. First of all, stakeholders are different, objectives are also different. You can understand, right, the complex nature of it. It becomes very difficult. Now example 2, this is an example of a university which is funded by government. Okay, here there is a different conflicting objective from 3 different stakeholders: students, government, and employer. They are the stakeholders of the university management. Student because students are going to study in university, employees because there will be some employees in that university, and government because they are funding that university. Now conflicting objective, we'll see how. So this university management, they are accountable to multiple stakeholders: students, government, and employer. But requirement of the stakeholders conflict. Okay, for example, we'll see how students, they want smaller class size, they want a bigger library, and they want courses that meet their personal interest. But government may wish to minimize cost per student. If university have to offer courses as per student wish, it becomes very costly, right, for government, because government's objective is different. They want to minimize cost per student. Third, employers, they want graduates with relevant skills for industry. For example, they want engineering graduates compared to some other type of graduates, that is anthropology, for example. Now, so in this case, designing a performance measurement system where multiple and conflicting objects exist is very difficult. So here, management has to rank the stakeholder and then give preference to the objective based on the rank. Next is value for money. When you come to the not-for-profit for organization scenario, another term you will often hear is value for money. This is not heard in profit organization. Here, the NPO's objective is to maximize the difference between benefits and the cost. Whatever the operation they are handling, what is the benefit, what is the cost? They want to maximize this difference as much as they can. That is the objective. Because so the maximization of this difference, in another word, is known as value for money. Higher the benefit, good it is. Lower the cost, higher the benefit. Difference becomes wider, no? So it's good. It is known as value for money. Bigger the value for money, better it is. That means higher the difference, better it is. Okay. So this is very similar to profit maximization. There they want to maximize profit. Here they want to maximize that difference. But the difference is they are not maximizing profit. They are maximizing society's interest. Okay. Now, so there is an increasing emphasis on value for money and achieving the 3 E's. There is another term known as 3 E's that you will hear in not-for-profit organization. 3 E stands for economy, efficiency, effectiveness. Economy means you are having the lowest input as possible. That means lowest cost through input. Input is the highest cost. I mean, input is the only cost that you have, right? To produce something, you need input and it's costly. So objective is to minimize that input cost. Efficiency, you want to maximize the ratio of output to input. And effectiveness, you are actually achieving the objective using the resources. Okay, the 3 E's. Same university example we are using here. How we can measure the 3E: economy, efficiency, and effectiveness. So for economy, the measure would be minimizing cost per student, which is the government's objective. Efficiency, maximizing student staff ratio. And effectiveness, quality of degrees awarded. Now, measuring performance is the next third aspect in NPOs. How do you measure performance in this organization with multiple and conflicting objectives? It's difficult, right? For example, let's say there is a very high percentage of first class degrees. But first class degrees awarded alone is not an adequate measure of the quality of teaching in a university. To measure that quality of teaching is good in a university, there are so many other measures, not only first class degrees awarded. So to cover these issues, performance can be measured by this. In not-for-profit organization scenario I'm talking about, okay? Use judgments by experts. Okay, and accept that no matter whatever you do, whoever's judgments you use, to some extent the measurement will be subjective. Next, use comparison. For example, for public sector, you can compare against the historical result to see how effective, how efficient, how economic you are. Using input, you can measure performance using input. For example, teaching staff hours paid or cost. But there are disadvantages also of using this approach. You should be aware of it. Keeping that in mind, because something is better than nothing. Not measuring the performance at all is still worse off than measuring the performance somewhat, even though it's subjective or it has disadvantages or things like that. Okay, because high level of input, if you're using high level of input, it does not guarantee that you are going to achieve the objective. For example, you might have great proportion of teachers there, but does not mean that they are actually teaching what is relevant or actually they are doing their job well. Because let's say only 75% of the hours they are paid for, they are teaching. They're not teaching the amounts or the hours, total hours that they actually have to teach. Maybe they are teaching actually less than them, but they are getting their salary, and it is, I mean, they say that they have taught the syllabus and things like that. Okay. So at the end, result might be you might not pass with great number of marks. I mean, with good marks. Then, so with university, output can be measured in terms of this. You can have a either broader performance measure or operational performance measure. Broader performance measurements, you can see the number of students that are employed after graduation, or number of publications by teaching staff, or proportion of students graduating. That is broader performance measure. Next measure could be operational. For example, number of courses offered, unit cost for each operating unit, or class sizes. Now we'll do questions on this area to test our understanding before we go on to the next section, that is environmental issues. Activity 1. This is the only question in this lecture, and thereafter onwards, in all my lectures, there are going to be questions, and the questions will be in the form of activities. So, this is given in your ACCA study hub for each subject. When you go and open the chapter, you will see there are some activities also there. Okay, so for those activity, you will be given space to write there, and the moment you click show, it will show you the answer. I have not copy pasted the answer here. The reason is I used to do that previously and I used to explain through the answer. But then I thought it's a very passive way of learning and students often don't remember much just by seeing answer and me telling that this. So in this, we are going to create the answer because you have to learn how to write answers also. Okay, how to write from scratch, which I'm sure not many of you are being taught. Usually, I'm not blaming any tutor or saying that whatever they are teaching is wrong or right. That's not the thing. But whatever the teach is the right thing, maybe the way might be different of each lecturer. But due to time pressure or maybe the time limit that they have given for to complete the syllabus, the focus is usually in completing the syllabus. That is just finishing the lecture or the content. But usually question answer are done by students, and it is given to students entirely to do it on their own. Usually I have not seen any university or anywhere they teach from scratch how to write an answer. Yes, they might say this is the answer, these are the things, or they might tell you the area also, or they might just read the answers for you, but it doesn't work. Okay, so in this lecture, and in fact all my lecture, if you have followed my AFM and the previous lectures that I've done in P levels, you will know that my way of teaching is I will explain you the question, and then I will show you how to attempt that answer step by step from scratch. Okay, so that's the same thing I'm going to do here. First, I'm not going to write the answer. I'm going to form a flow chart. What are the main areas? What are the things you need to do? After that, we are going to sort out this answer. We are going to structure the answer and write it in an appropriate form. So let's do that. So in this question, this is activity 1, the first activity, and it's for not-for-profit organization. And you will see that in this question, you need knowledge of ratios, and it's an assumed knowledge from your management accounting. So whatever you have studied previously, even if you got exempted, there are some knowledge which are carried forward as you proceed along. Okay, for example, you have level papers, the knowledge will be brought forward in your P level papers. Okay, so I'm not going to teach ratios from beginning again, but there are some ratios you need to calculate. As you can see, if some figures are given here, from that you know some ratios needs to be calculated. Okay, so this case study, take your own time and just log into your ACCA website and read the questions. Take your time and do read it. I'm not going to read the entire question and take your time. Let me tell you a brief scenario of this case study. So this is about a public transport giving services, and they have given their income and expenses, they have given their profit, they have given their some measures, and they have given some industry measures as well, which you have to compare. Okay, because this is a public, I mean not for profit, so their objective is different. The objective is to provide efficient, reliable and affordable public transport for all the citizens. Okay, so you can say they are charging low. Okay, they are taking, sometimes in some area they are taking some small number of passenger where private sector might not go because it's a loss for them. Okay, but public sector does it. So you have been given the passenger fee, that is your revenue, and cost. You can see three types of cost: staff wages, fuel and depreciation, because you have to travel, and you have a surplus of 20,000, and capital employed has been given. Now some statistics: total passenger carried and total passenger miles traveled, and you have been given industry average ratio. This is to compare. Okay, you have been given return on capital employed, return on sales, asset turnover, average cost per passenger mile. This ratio is of no use if you have nothing to compare with. So you have to calculate your own set of ratio. First we'll see the requirement. Okay, so in your activity, when you go to your ACCS study hub, this is the way questions will be asked. Just see, this is the format. It has not been changed. Okay, before we had test your understanding when we did Kaplan, it is same like that, but this is more like you can say exam standard. Okay, three requirements. A, compare performance. So you have to compare this with the private sector. It is, in short, they're telling you you need to calculate ratios, but just calculation is not enough, you have to comment on it. B, now you have to say, discuss the validity of comparing LBC with private sector. Is it valid when you're comparing? Because remember, private sector and LBC are different. LBC is not private sector. Okay, then C, you have to explain the meaning of economy, efficiency and effectiveness, the three E's, and you have to suggest a measure of one each appropriate to a public sector bus transport. According to the case, you have to say what would be an economy measure, what would be effective measure, and what would be an efficiency measure. This you have to choose based on the case study. This you cannot, your textbook will not help you here. Okay, so for example, if it was some other construction company, then your threes will be different. Okay, three ways will differ. So now it is understood that uh, ratios you have to complete. Okay, because numbers are there and you have to write. So let's do with that. Now tell me, we know ratios we have to complete, but what are the ratios? You have to be very smart enough to choose the right ratios. Why? Because when you studied the ratio, you must have studied a list of ratios: profitability, liquidity, you studied debt, receivable collection period, payable payment period, inventory turnover ratio, gross profit margin, net profit margin, then gearing ratio, then interest cover, dividend cover, so earnings per share, price earnings. There are so many ratios, but you should not put those ratios. Those ratios you should not calculate, and you cannot calculate also because you don't have such information. But if you are attempting to calculate those, it's not worth it. So the starting point is, even before you write, you have to calculate, because on your calculation only you can comment. Remember that. Okay, because they told using the information provided above. So your starting point is this ratios. See, here there's a list That means you have to calculate this, you have to calculate this, you have to calculate this, you have to calculate this. Maybe some further ratios. Don't limit yourself to this 4 ratios. Some other 2-3 ratios you can calculate from this information given here. From this two information, make use of it. Always try to make use of information. Think what ratios I can come up with if I have this piece of information. So we'll start with return on capital employed. Okay, we'll start first writing the ratios. Okay, so let's do that. And when you are doing ratio, okay, when you are doing this question, don't write one ratio and then talk about it, then calculate another ratio, then talk. No, in one go calculate all the ratios, keep it in one place, then start writing. This saves time. This saves a lot of time rather than doing it the other way around. You write, then you calculate, then write one ratio, talk about it, then you calculate another ratio. Individually you're talking about each ratio. Does not make sense, because ratios are interrelated with each other. Sometimes 2-3 ratios you can write under one heading and save time. It happens like that. Okay, so let's do that. And when you are doing these ratios, when you're doing this on a CB platform, since I'm not doing this on a CB platform at the moment, but when I do revision kit questions, definitely everything will be solved in CB platform. Okay, activity questions will be done on OneNote. So make sure that you do it on a CB platform. There you have to do it under Excel. Okay, in Excel will help you to do it much faster. So we'll start with, so now you know first point is return on capital employed, first point. Okay, and it's requirement A also, so makes sense. So we'll do that. So we'll write ratios. Okay, calculation of ratios. We'll always put a label. Okay, if you're putting anything, put it under a heading. It makes easy for examiner to give you marks and they know, rather than just writing some number 23%, 30%, 40%. No, don't do that. So for example, I wrote calculation of ratios. Okay, now first ratio, return on capital employed, ROCE. Okay, write the formula, because then you know what you are choosing. So what is the formula for ROCE? This is an assumed knowledge from your previous paper. You have to know it. In your exam, in your formula sheet, this formula is not there. All those ratios formula, you have to memorize it in case you forgot. So ROCE formula is operating profit divided by capital employed. We have been given capital employed somewhere. I remember when I was reading it into 100. Okay, so now we'll put it. So operating profit, how do you get the operating profit? It is the surplus. In your finance profit organization term, this is known as profit. But in not for profit, it's surplus. So that surplus only you have to take as profit. And capital employed you are given. Remember one thing, this is given in thousands. They have dropped the 3 zeros. So when you write it, it will be 20,000. If you don't do that, then if you write this as 20 and for example, you write 20, 2210, think about this. Number changes, no? It should not, it should be 20,000. Either you can do like this, or if you want to keep it as 20, then you have to drop this 3 zeros also. 1, 2, 3. So it will be 20 divided by 2210. Try both ways and see, you will get the same answer. Either drop the 3 zeros from the capital employed or add 3 more zeros to this 20 surplus, because both has to be in the same term. One cannot be in 20 and the other one in thousands. If you're dropping 1,000, it has to be from both the places. If you're writing the full figure, both the figure has to be written full. Many students, often students make this mistake. They write 20. No, it's 20,000. Just check up. 3 zeros has been deducted to make it simpler and easier, right? It's easier to deal with smaller number. Even you need to do this when you're calculating net present value and all in the future. Okay, dropping the millions or in thousands or in 10,000 like that. Usually we keep it in thousands or millions. These are the two most common measure. Okay, anyway, so it will be 20,000. Okay, divide by, I'm keeping the full number so that there's no confusion, into 100 equal to You also calculate this while I'm doing it. Don't entirely rely on my work. Okay, if you do it, you will learn it. Okay, that's how I learn my formulas. I always do calculations, write the formula, do calculation, write the formula, do, keep on repeating until the formula is memorized. So 0.9%. It's not 90%, it's 0.9%. Keep it. No need to compare. Start doing all the ratios first, whatever you can think. Next ratio is net profit margin. As we can see from here, return on sales is net profit margin. Okay, it's the same thing. So net profit margin. So net profit margin formula is operating profit or net profit divided by sales into 100. Operating profit we know is 20,000 is the surplus, and the sales, when you go to sales, it is this 1.2 million. Okay, that is the passenger fares, that is your revenue. So you are going to write 1.2 million. So 1200, another 30 into 100, and you are going to get 1.7%. Very less, right? Because it was some 30% in the industry. Third ratio is asset turnover. You see, now work becomes very neat, you know, one after the other. Asset turnover formula is sales divided by capital employed. Okay, into 100. What is sales? Just now we have got 1.2 million into capital employed 2210, and the percentage is, sorry, this is not percentage wise, asset turnover, it is in terms of times, 0.54 times. That's a mistake I've done. It's fine, because if you see here, asset turnover is written in terms of times. You have to keep the unit same. You cannot write one in percentage, the other one in time and compare. Then next, average cost per passenger mile. So first three completed. See here, when they have calculated, they didn't give you the formula. Okay, you have to know. Sometimes they give, but mostly they don't give. Okay, they just give the measure. So average cost per passenger mile. What is this thing? Operating cost divided by passenger mile. How will you understand the formula? Very easy. Just look what comes first. First comes average cost per. Per means it's in the denominator. So cost. So it's cost divided by passenger mile. Okay. So it is operating cost divided by passenger miles. Okay. Passenger miles. Now, what is the operating cost? Operating cost also you need that account. It is this amount. The addition of all the cost. 1180. Okay. So it is 1180. 3 zeros I'm going to add. That's in millions. And passenger mile they have given you. They have given you below this one. This is the passenger miles traveled. Okay. So we are going to write that here. 432000. Okay. Now, sorry, equal to, it is 0.27. Okay. Now one additional thing you can add is fares charged by the bus service. This is the next one. That is not there, but you can do additional. Fares charged by bus. For both you have to find, because it's already not given. One you have to find for the private sector, the other one you have to find for the public company. the public transport. Okay, what is the name of the company again? Louisville Bus Service. So I'm going to write LBS. LBS. Okay, fare per passenger mile. Fair enough, no? You can calculate the fare per passenger mile for both LBS and the private sector. Private sector fare per passenger mile. Okay, formula is going to be same. Is it? Is the formula going to be same? No, because this is public sector, this is private sector. There are some differences. Okay, so here it will be fare, passenger fare divided by passenger mile. And here it is going to be average cost, because in the private sector cost is given. Then when you're finding mile, I mean for private sector, if you have to find the revenue, fare per passenger mile, that means in short you are finding sales only, right? Cost to sales. How do you do that? See, here if you see return on sales, net margin is 30%. Using this you can do. Why? Because your sales will be, that is net profit after, so 1 divided by net margin. So here passenger fare is what? The sales 1.2 million divided by passenger mile already given 4320, 0.28, and average cost. What is the average cost? Pay careful attention here. Okay, they have already given you the average cost per passenger mile for industry. This you take for the private sector. For private sector bus itself, so 0.37. Now 1 minus net margin. Net margin is 30%, so 0.3, and you will get 0.53. Okay, so now you can bring all this here and you can write here also and calculate. This is private sector, this is LBS. How much return on capital employed did we get? 0.9%, and this one 1.7%, this one 0.54 times. Average cost 0.27, and other two is fare charged by bus service, that is I mean you don't have to write there next to this one, but I'm writing so that it becomes easy for you to compare, otherwise I have to keep going up and down. So for private sector it is 0.53 and 0.28. This is the new one which we calculated. Now compare. So now we'll start writing, because you are supposed to compare the performance, right? That is right. How do you write? Start also in that order. The way you have calculated, start in that order. For example, you will first talk about a return on capital employed, then return on sales, then asset turnover, then fare, then average cost, all those things one after the other. And when you are writing it, you are writing it in different paragraphs. Okay. So for example, now A is what? Performance comparison. Just use for A, when you're writing answer, just use one subheading or a heading. You have to use one heading for each. This is the way of writing any answer in ACC, because it becomes very easy then what you are talking about specifically. Keep it in 2 to 3 words. So here it's about performance comparison. So we'll write performance comparison. Done. Now some ratios you can compare. For example, when we have studied ratio, we know it is divided into groups: profitability, liquidity. So these two ratios can be divided into one, that is profitability ratio. It talks about profit. What? Just compare. Which one is better? LBS or the private sector? Private sector is better in terms of both. Because if you see return on capital employed is 10, whereas it is very low here, 0.9%. And return on sales is 30, whereas LBS is just 1.7%, very less. So conclusion is, in terms of profit, LBS is not performing good. We all know that. Now how do you write in words? Structure this answer. So you will talk about saying that when you look at this profitability, looking at profitability, company is performing poorly. That's what you have to write. Okay. So I'm not writing the entire thing, but I'm explaining you. You can go always, and as I told you, once you click there, when you go to ACC website, you need to go there. And when you click the show, it will show you the answer down. And you scroll down, you will see the answer. It's written. So since it's written there and you will get it there, I'm not writing the answer, but I'm showing you the process. So when looking at profitability, you have to write it in full proper sentence, okay? LBC performed, because it's about performance, perform poorly. Okay, they have performed poorly. Don't write perform poorly, just full stop. No, compare it against to something. So compared, performed poorly compared to, what did you compare it with? Industry averages, no? Compared to the industry averages for the private sector. Now you have to make mention of those number somewhere. So here you can write the two ratio, that is ROCE, profit margin. So ROCE is, it was 0.9%, right? It's 0.9% compared to, always write compared to 10% of blah blah blah. The rest you can fill in, right? Of private company. And here is 1.7% profit margin compared to 30% of private sector. You can fill in the blanks. So this is how you write. Even though calculation you are not showing you the main answer, you might think that okay, calculation I will keep it separate working. Still make mention of this figure in the answer. It's going to give you marks. Now what else? This is not it. This is not over. We are still in the performance part. We have still not reached to asset turnover, the third ratio. But before that, there is something that needs to be done. What is it? You have to give reasons. Yes, you have to give reasons, my dear friend, that why it is low. You can come up with anything why such difference could occur in the public sector. So give reasons now. So one reason could be that as a public sector provider, LBC has to provide services on less profitable routes also. So you write that reasons. Reasons for this above. LBC has to provide services to less profitable, from less profitable routes also they are taking their buses. Next reason could be, what is the next reason? They are charging lower fares, okay? They are also charging lower fare than private sector. Lower fare. Always talk in terms of comparison, okay? That you are comparing it against something and then write. Don't say it's low. Say it's lower than this one, or this is less profitable than that one, like that. Now, what's the next reason? Maybe now you can give some advantage. Okay, this is bad things. So give drawbacks. Now talk something positive also. What is the positive thing here? That LBC is not a private sector. So because LBC is not a profit making company, or you can say commercial enterprise, because it's not a profitable making company, then what is its mission? Then its mission, what was its mission? Is to provide efficient, effective, and affordable transport. Its mission, link its mission here. Its mission was very told. I've highlighted also. Efficient, reliable, affordable. This was their mission, right? So you talk about that mission. So Elvis is not a profit making company, then its mission is, you write it. So in this case, what happens if that was their mission? If it is this their machine, such profitability measures are not relevant then for them, because that was they are not it was not their objective also. Profitability measures are not relevant. Now next ratio, it is asset turnover. So in terms of asset turnover, what you can talk? All right, this is the answer of that. Okay, this are all the ratios that we have done, and this is part B. Part A's answer is not there. Okay, so reading the answer straight away is not going to help you. Okay, but now since after I'm teaching you step by step to do this, now when you go back and read the answer, it will make a lot of sense to you. You will understand from where, how it comes, and then you can create any answer. Okay, so next is asset turnover. What is this? Asset turnover is the other way around. If you see asset turnover, it is higher. It is 0.33 and here it is 0.54. In terms of asset turnover, it's good. But just writing it's higher is not enough, right? So asset turnover is higher for LBC. Then I told you always compare. Then for private sector. After that, now give the number. So once you first you begin by saying higher or lower, then you give the number. Okay. LBCs, you can use short forms also. LBC. Examiner will understand if you use like this in the question. Revenue is 0.53 times. See, the ratio is asset turnover. Turnover means revenue. Okay, so that's why they have talked about revenue. LBC's revenue is 0.53 times capital employed. That is the meaning of this. Your revenue times capital employed. Okay, then you write compared to 0.33. I'm not writing it. You can write it on your own. So compared to 0.33 for the private sector. Now, again, I told you reason. So it's higher or lower, give a figure, reason. Higher or lower, figure, give a reason. It keeps repeating. I will write it somewhere. This is a standard way of writing writing ratio answers. You can write it somewhere. High or low number, 1, 2, 3 reasons. Follow this all the time. Any subject, not just this subject, even your financial reporting or tax or audit, any paper where you have ratios, you follow this method, it works 100% of the time. Okay, no doubt about it. provided you know the reasons, some valuable like reasonable reasons you are able to give. Now think why asset turnover could be high. This suggests, what does this suggest, this measure? This suggests LBC's, I'm not writing the reason, you can write it, but LBC's bus achieves higher utilization than private sector buses. That means they are able to utilize their buses better than the private sector. This is the meaning of this. Okay, LBC utilizes their buses better. How can do the, how, the question is how they utilize it better? Because they are paying lower fare, low fare. So if low fare is there, lot of passenger comes. Passenger wants low fare, right? So fares are low. Then even the buses are used. Buses are utilized to the full extent. How? One is low fare. Next one, they are able to cover more journey per day. So buses, more journey per day. Always write then private sector. I'm not writing it for you, but you can write it. Okay. So in terms of fare also is lower than private sector. In terms of journey that bus is making per day is more than the private sector. Rather than lying idle. Okay. So this is a good sign, isn't it? So in terms of revenue, they are better to better utilizing their buses. Now the third one. I'm sorry, the fourth one. Cost per passenger mile. Cost per passenger mile. Okay. What was the, in terms of this, industries one is more, right? It was some 0.37 and the one which you have calculated is 0.27. It was here. Wait, we'll go up and show here 0.27 and 0.3. Okay. So when you compare this, okay, because we want to calculate the in terms of percentage how much is the cost per passenger mile. So it is, if you take like this, of LBCs over the industry, that is 0.27 divided by 0.37, 73%. So 73% is the cost per passenger mile for LBC. It's positive or negative? Positive. This is positive because it's less, no? Cost per passenger mile is less for them, so it's positive. How it is positive? Because the company is managing to provide more journey distance for a lower cost. That is the meaning of this. They are traveling a greater distance, but the cost is low. Write it here. Okay. Provide more distance for lower cost. So in terms of this measure also, they have performed well. What could be the main reason? Again, reason. High number of passengers is one of the reason. Because it makes sense, right? If you are paying low fare, a lot of passengers will come. And also, the next reason is the bus routes may also be longer. Possible. Right? Because LBC might go to some areas where, like suburbs that are far from the main city, right? They might cover those roads as well, which private sector will not cover because it's not going to make them any profit. Now, the last ratio, fares per passenger mile. if you want to calculate this in terms of percentage, what was LBC's? It was 0.28 and private 0.53. So in terms of percentage, it is 53%. Okay, 53% of fares per passenger mile are charged by LBC. So we know what happens. If you see in terms of revenue that is collected per passenger mile, 0.28. This is why LBC is less. So earlier we have discussed why our revenue is less, because we charge lower fare. So we have discussed that earlier. So when you have discussed something earlier, make mention of it in your answer, that as discussed previously, that this is the reason for declining profitability, right? So don't repeat it again. This is what you have to stop doing it. Avoid. A lot of students, what they do, what they have written before, they will come and write it again. Why this is low? Because fares are low. I mean, they have charged low, so profit is low. You don't have to write it again. Already as explained before. So just write as mentioned before. Okay, and then go to the next point. But even though fares are less, but it is going to be liked by the user of the bus, because lower fare means it's a policy of providing affordable public transport. That was their objective also, right? So we have discussed performance in terms of all the areas. Now part B, whether it is valid to compare or not. So since answer is here, okay, I'm going to take you through the answer. See how it's written. So these are the 3 top reasons why you should not compare. First of all, can you compare? Does it make sense? For me, it's not valid, because one is private sector, one is public sector. So that is the first thing you have to talk about. Their objective is not same. So objective. First, the objectives differ of LBC. Okay, first you say that it's not a valid exercise, because that was the question. Then you say why? Because first the objective differs. Objective of the LBC are to provide efficient, reliable and affordable public transport. Whereas private sector, what is their objective? Maximize shareholders' wealth. These are some keywords. Make sure that these are in your answer. I don't care how you write it. Okay, you can write it in a very beautifully, you can design and write it in any way. Okay, but this words has to be there. Okay, private sector, maximization of shareholders' wealth. Public sector, these are the objective. Okay, then reasons. Okay, some more reasons you can give. So you can talk about ratios. You can talk about what are the ratios we have compared: return on capital and profit margin. It's not valid. It's not relevant for LBC, because organization is not there to make a profit. So you can talk about that. What is the next one? Private sector could be very cunning. Okay, they might have picked those routes which are most profitable route. Okay, so they might not go to less populated route, but a public sector will go there, because their mission is to provide services to all citizens. And the third reason about lower fare. Okay, they are charging lower fare to certain group, for example children, or to the one who is earning a pension. But private sector, they will not do this, because their role is to maximize profit, so they will price also in such a way. Okay, so even though, see, whenever they say whether something is valid or not, try to give positive also. Both the sides you have to give. Okay, so these are negative. Now positive side. So some benefits. What are the benefits? Comparing helps you to figure out what is the cost of running the service. Are you in line with it, or are you your cost too high? Then about your quality, is your quality good? Then utilization. For example, asset turnover was a very good this thing. Okay. Next is part C. Part C answer is also not here, but let me talk about it, and you can write it on your own. which is about the three E's. So you have to give each measure, okay, of the three E's. This is easier to talk about. So economy, first E. Then effectiveness, yes, and efficiency. So economy is an input measure. Okay, economy or input. This is an output measure. And this is the balance between both input and output. Okay, so for economy, what would be the measure? Cost. Input is the cost mostly. So they can compare the cost with budget. Okay, their input would be compare cost with budget. This could be their measure. Because cost is their input here. They want to minimize this. That is the objective in economy. Next, effectiveness is an output measure. So whether organization have achieved their output or not, that's what effectiveness measure. So what is their output? Number of passengers carried could be one of the objective for effectiveness. Or number of passenger miles traveled. And for efficiency, it is the balance between the two, input and the output. It is like a relation of output to input. Okay. So for this company, measure could be cost per, cost is an input, output is the passenger miles travel. So cost per passenger miles travel could be the measure for efficiency. You see, it's taking both. Cost is from input, passenger miles travel is from output. So input to output. So the next on the list after measuring performance is environmental issues. This is a growing concern for any stakeholder, okay, and green issues will be discussed in lecture 2. So it's important that managers understand how the organization's operation affect the environment in order to satisfy public concern and to avoid any penalties or environmental regulations. So for this reason, you will see that environmental reporting has become very important. Significance of it is increasing. Now, some organizations have adopted triple bottom line approach, okay, where they take environmental and social factor also. So triple bottom line takes 3P into the account: people, planet, and profit. Profit is the economic factor, people is the social factor, and planet is the environmental factor. Okay. Now, green policies and sustainability, as I told you, will be discussed further in lecture 2, and is also very important because this is a new area that has been added from this year onwards for financial management, which I've discussed when I went through the syllabus. Now, next, the third part of this lecture is the stakeholder. Conflicts of interest between various stakeholder and how it is managed. Before understanding stakeholder, you need to understand one concept known as agency theory. What is agency theory? Agency theory is a study of duties and conflicts that occurs between parties within a company that have an agency relationship. Not everyone has an agency relationship. From the word agent, you can understand it's like you are hiring someone to do a task on behalf of you. So that is an agent for you. Okay. Now, this is a diagram for you to understand principal agent relationship. Principal is the main person who could be owner, who could be an employer. Okay, he or she hires an agent to do a task on behalf of them, and hence there are some responsibilities that agent has towards the principal. For example, principals could be shareholder, director, or loan creditor. So for shareholder, the agent would be director because they work on behalf of shareholder. For director, they will hire employees, and for loan creditor, it is the shareholder. Agent's responsibility, if it's a shareholder director relationship, is to generate maximum return for shareholder. If it's an employee, they have to work to maximum efficiency, and if they're shareholder, they have to minimize risk from user borrowed fund because they are answerable to loan creditor. Now, so this theory gives an overview between various interest groups, and the company will not succeed unless all the groups are working towards one objective. Could be one or two, but same objective. And researchers have found that often, okay, 99.99% there is always a conflict between the agent and the principal, or the director, the shareholder. That's why there are so many issues that is coming into the picture because of this agency relationship problems. For example, when assets are close to its liability, okay, your loan provider will pressure the director, or debt investor will pressure the director to only undertake a low risk project because they don't want liabilities to go above the asset. Even if asset comes close to liabilities also, they will undertake low risk project. Okay, why? Because the debt investors gain nothing from that risky project. They will only receive that fixed interest. So their return is only fixed, but they have lot to lose. They are going to lose everything. And if assets fall below the liability, company will become unable to service its debt. They will not be able to pay back its interest, which is an obligation that they have to, no matter what. So equity investor, on the other hand, they will encourage you to take risky venture. Why? Because they are going to get return, no? Higher the risk, higher the return for them. And also they have a protection from their status, that is limited liability status, which says they will not be forced to cover any losses beyond what they have contributed. Okay, so now there are various types of stakeholders. Stakeholders are any party who have an interest in the company, who can affect the company, and the company also can get, they also can get affected by any decision made in the company. So it's the two-way relationship. Either they could affect or they will get affected, right? They are known as stakeholders. We'll start with the prime stakeholder, that is shareholder. Their objective is to maximize wealth. We'll see how differing objectives will lead to conflict of interest. So shareholders' main objective is to maximize wealth. Next stakeholder is director. Their objective is to get good amount of remuneration. They need the power. They should have high self-esteem. An employee, their focus is on job security, and their pay and condition should be good enough. Then we have loan creditor. They want security, long-term prospect, and cash flow should be strong. Trade creditor, you should be able to pay them in short term. And community, they will take care of the community support and environmental issue. You see, each of these objectives are different. If you want to maximize wealth, you have to forego the other areas. That's why conflict occurs. It could occur between any two parties, or three parties. Okay. For example, shareholders might have issue with loan creditor. Shareholders might have with director. Director might have with the community. Any way it could go. Okay. Now, stakeholders are grouped into three categories: internal, connected, external. Internal means inside the organization, like employees, director. Connected, they are no internal, no external, they are both. But they are connected, they are the middle party. Shareholder. You might say shareholders in internal. No, they are not internal. They are not managing the day-to-day running of the company. They just invest, and they rely on the director to give them the reports, and also they are connected. Same way customer. They're not inside the organization, but they're part of it. because without customer, how can we do a business, right? Supplier also is the same way. Competitor also connected. External, outside, like government, pressure group, national community. Now, so for example, we'll see how a conflict arises. Let's say community's objective is to reduce environmental effect. This will reduce the profit for the shareholder, which is maximization of shareholders' wealth. Now, so we'll see how we have come to the agency theory. Okay. So shareholder, earlier it was not an issue. Why? If you see the earlier days, the owner only controls everything. He invests and he only manages everything. So it's like sole trader or partnership, one person doing everything. They don't need another person to do a job on their behalf. So no agent, no principal. He or she does and manages everything. Now, world has changed. You will see a lot of limited liability company where shareholders that they just invest, but running, they will have the control. But who runs day-to-day operation of it's the director. So there is a distance between who owns and who controls the organization. That's why this agency relationship came into the picture. That's why these problems then came. That's why solutions then came how to solve. And it's not costly. I mean, it's not cheap, it's costly. Okay, it's not free of charge. Okay. To mitigate those agency problem issue also, it's costly. So according to rules, ethics says that okay, directors are hired by shareholders. Their prime duties towards shareholders is to maximize shareholders' wealth. Okay, but according to the new concept, according to the modern corporate governance, they say directors should not only take the shareholders' interest, they should also take the interest of the other stakeholders also. That means they are responsible towards creditors also. For example, by having a reasonable payment terms, they are responsible towards employees also, health and safety. They are responsible towards the society also, not to have pollution. Therefore, if you see the corporate objective, overall corporate objective cannot be maximizing profit any longer. It should be satisfying because he has to meet the shareholders' needs and also the other people's needs also. In that, you cannot maximize profit. And also, if you see, there is a rise of the ethical investors now in the world stock market. So even shareholders are now willing to accept slightly lower returns in exchange for their companies following a wide range of objectives. That is both financial and non-financial. That's why we have this term known as green or sustainability finance, which we are going to cover in lecture 2. Now, so first type of sets of conflict of interest, the major one is between director and shareholder. As I told you, there's a separation of ownership from control. Directors control, they run day to day, shareholders own, they have ownership there. But there's a distance between it. Okay. So, yes, it is the best practices directors are there to manage the company on behalf of the shareholder. That's why they should always act in the best interest of the shareholder. But tell me, is it so? Does it work like that? If it works like that, there would be no issue in the world. All of the issue, 99% of the issue is because of this agency principal relationship issue. Directors have some other objective that they are fulfilling. Shareholders' interest is something else. They are not aligning, hence the business collapse or something happens, right? Because they will be taking care of their own interest. Okay. So this is not the case. Directors have other personal objectives such as they want to increase their personal remuneration level. They might want to maximize their bonus. They want to build an empire or they want to secure their job. So because of those reasons, there are some decisions which they don't take. That is not the best decision for the company. Maybe for them is good, but not for the company. For example, they then use creative accounting because they want to show the accounts in a better position so that they can get their bonus or remuneration. Next, they might use off balance sheet financing using special purpose vehicle. Then they might reject some takeover which might be good for the company. Why? Because they want to secure their job. And they disregard environmental issue. Directors allowing pollution emitting process and product testing on animals in order to increase sales, profit, right? One example of this agency issue only took place and the company collapsed, and also auditor was penalized for it. Tell me an example of it. The auditor was Arthur Edison, right? Arthur Edison was the auditor who audited a company. I forgot the name of that company. It was a very famous company. I don't know how I forgot. Right now, the name of the company is not coming to my mind. But there was that company where all this took place. Creative accounting was there, offsheet balancing was there. Financial statements were manipulated, and this went on for 5 years. The issue with the auditor was the auditors were also supporting it. They know it, still they kept on giving a good audit report saying everything is good, fair. But 5 years down the line, the business collapsed, right? I'm sure that you must have thought, you know about the company the moment I told Arthur Edison. Okay, so that company only. Now, so if directors follow their own personal whims and objective, the issue is it leads to agency cost. That means there's a loss return for shareholders. This is referred to as an agency problem. So according to good corporate governance, procedures should be implemented to minimize the effect of agency cost. But even those implementation of corporate governance comes with a cost. For example, in US, we have a framework known as Sarbanes-Oxley Act. It's very strict, very rigid, and very expensive for small and medium-sized companies. So here also a cost-benefit approach should be taken to determine an appropriate level of control over director. Now, if you want to control the director, reduce this agency problem, do a cost-benefit analysis. Next. So it could be argued that what is the actual return to shareholder? Simply the maximum potential return minus the agency cost minus the cost of engaging in corporate social responsibility, because they are cost. Okay, and to some degree, okay, shareholders should become more active in monitoring the behavior of director. They should not leave everything entirely in the hand of the director and become blind and trust everything on the face value of what is told to them. No, they have to become more active, especially if they are the shareholder of the listed company. Because if you see, most shares in listed company are held by institutional investors, and these are managed by fund managers. Okay, so fund managers are often found guilty of operating in a very passive way. For example, proxy voting rights are not always exercised by institutional investors. Proxy voting right means on behalf of you, someone else is coming and voting for you. That is known as proxy. It is not always exercised. And unless there's a rise in shareholder activism means they are becoming very aggressive towards being more active. Directors will continue to work in their own best interest. I mean, come on, it's human nature. Who doesn't want to? If they have the opportunity, okay, if they know no one is going to watch them, they are not going to be caught, anyone will do it. It's human nature. Okay. Now, to overcome those, we have some schemes, certain schemes we have, okay, to align the stakeholder objective. Okay. One way is through designing the reward scheme. Okay. Which will help you to lead to goal congruence. What is the goal congruence? It means they will have similar goal. They are in line. They are not going to have two separate goals, the director and the shareholder. So agents will act in the best interest of the organization. So managers should be encouraged for long-term growth rather than short-term profit. Now, there are methods of encouraging this goal congruence between director and shareholder. First way, reward system could be performance related pay. Okay, so problems often starts when you relate your pay or bonus to the profit. Why? This is short term. Then everyone will take care of profit. They will somehow try to increase that profit even unethically. If you pay them a salary or bonus according to the profit, because then they will not invest in the future growth to maintain high profits. I mean, not invest for future growth, incurring cost today, because they want to increase the profit today in the short term, because their bonuses are related to it. Okay. Next way is executive share option scheme. Executive share option scheme means, we have discussed this before, you are giving a share option right to purchase share to the director. Okay, that is known as executive share option scheme. But the evidence is mixed from this reward scheme. I mean, success is mixed. It's not always successful. The directors are going to act in the interest of the company. Why? Because company share price might sometimes rise due to rise in the stock market rather than the performance of that management. Then, third one, long-term incentive plan. So here you are going to pay bonus to the director if the company's performance over several period of time is good and it is benchmarked against the competitor. It's good. Transparency in corporate reporting. Then it's hard for them to hide anything. And increase shareholder activism using voting rights and improved corporate governance. Appointing non-executive director. Now, next way is through corporate governance. You can align the objective of the shareholder and the director. That is, first understand what corporate governance is. Corporate governance is like your compass. It guides you. You know what is right, what is good and bad. What should you do at that condition, the situation? That is corporate governance. How you will be directed and controlled. So the main objective of corporate governance is to reduce the agency cost that is acceptable to shareholder. You cannot entirely eliminate it. It's not possible. But at least you can reduce it to a level acceptable to shareholder. There are some principles of good governance that you should know. Okay, remember, every country has their own codes on corporate governance. You should not have a detailed knowledge of the codes. It's not required. But at least be aware of the basic principles, some main principles, 4, 5 to 6. Okay, it follows those codes also. Okay, any countries, whatever the code they have, will follow this principle. First, every company should have an effective board. Effective board means they should have an executive director, non-executive director. Next, chairman and the CEO's responsibility should be divided and not be run by single person. That means single person cannot be both chairman and CEO. They have to be two separate people. Third, the board should have a balance, 50% I would say, executive and 50 independent non-executive director. The role of independent non-executive director is to supervise the work of executive director. Then all directors should be required to submit themselves for re-election on a regular basis. Now, then remuneration committee, okay, should have 100% independent non-executive director. It should be made up of all independent non-executive director in that board. Doesn't matter whether 2 or 3 or 4 or 5, number doesn't matter. All has to be independent non-executive director. Then the remuneration committee, the packages that they are giving should be in such a way that it should attract, it should retain, and it should motivate the executive director. And you should not pay beyond that. No director should set their own remuneration. Only non-executive director could do that for you. And the board should maintain a solid internal control. This is to safeguard the shareholders' asset and investment. Now, the next way is government regulation. Okay, if you see in UK, we have UK Corporate Governance Code. And to have a listing on the London Stock Exchange, you have to comply with this. It's compulsory that you have to comply with UK Corporate Governance Code. But the compliance is not obligatory. Compliance is not obligatory means we are not talking when we are listing on the London Stock Exchange. Otherwise, generally, when we are running a company, okay, compliance with UK Corporate Governance Code is not compulsory. I mean, it's not obligatory. It is something voluntarily. If you want to do, you do it, and it's good. Because later on, when you want to list on the London Stock Exchange, you definitely have to show that you have complied with UK Corporate Governance Code. Okay. In case some of the codes of that corporate governance code you have not complied with, you must explain the reason why you didn't comply. This is for listed company. Any listed company which does not comply with the corporate governance code, you must explain reasons why you didn't comply. But in US system is different. It is not principle based, it is rule based. All companies have to comply with US Sarbanes-Oxley Act whether you like it or not. It's compulsory, mandatory. Not only the US company, the company that are listed on US stock market, also their foreign subsidiaries should comply with US Sarbanes-Oxley Act. And let me tell you, it's very expensive. Now, listing regulation. So, stock exchange has put this listing regulations in place so that stock market operates fairly and efficiently for all the parties. Because they need these listing requirements. If these listing requirements are there only, they will get the approval to get listed on the stock exchange. Otherwise, they will be stopped, rejected. So that's it. I've covered the entire section A of FM syllabus. So let's see from our syllabus how much we have covered. This is section A, financial management function. 4 parts we have discussed. First part, nature and purpose of financial management. Here we have gone to 2 things. What is the purpose of financial management and relationship between financial management, financial accounting, and management accounting. Then second, financial objective and corporate objective and corporate strategy. Relationship between these 3. Next. Then we identified varieties of financial objectives. The main 3 are shareholder wealth maximization, profit maximization, EPS. Then we went through the stakeholders. Okay. We identified range of stakeholder. Customer, supplier, whether internal, connected or external. Then we discussed the conflict between the stakeholder. Third, we discussed the role of management in meeting stakeholder objectives, applying agency theory. Then, how to achieve corporate objective, including changes in dividend and share price. Then, explain ways to encourage achievement of shareholder objectives, like through reward scheme, like share options or performance related pay. Then, regulatory requirements, like corporate governance code of best practice and stock exchange listing regulations. So, fourth one is for not-for-profit organization. 3 things: the objective, the value of importance of value for money, and the 3 E's. So the C is 3 E's. Discuss the way of measuring the achievement of objective is through 3 E's, that is efficiency, effectiveness, and economy. That is for not-for-profit organization. So we have covered all this. You will be able to answer all this. That means we have finished this part of the syllabus. Now let's summarize the lecture. Some important points. First one, before you develop an objective for the organization, identify the relevant stakeholder, because later on they are going to have an effect on that objective. Second, principal stakeholders are shareholders. So the traditional finance theory is company's objective is to maximize shareholders' wealth. Shareholders' wealth is measured by total shareholders' return. that is dividend and share price growth. We have done questions on that. Often, profit maximization and EPS growth are used as proxies for shareholder wealth maximization, because we have gone through the limitations of shareholder wealth maximization also, and told that sometimes as a substitute, profit maximization or EPS growth could be used, even though they both also have limitations, because they are profit, and profit are easy to manipulate, but shareholder wealth is cash based. Then CSR. CSR tells you take other stakeholders' interest also into account. That means you have to follow some non-financial objectives also, like reducing environmental effect, satisfying employee. So non-financial objectives can be in the conflict with your maximizing shareholder wealth. Okay. So then your overall objective becomes from maximizing to satisfying shareholders' return, because you are meeting the demand of other stakeholders also. Then it becomes difficult for you to maximize your return. Then you satisfy the return. Not-for-profit organizations have multiple objectives with multiple stakeholders which are in conflict. So objective of many not-for-profit is to maximize value for money. That is 3 E's: efficiency, effectiveness, and economic. Then agency theory examines the duties and conflicts that occur between parties within a company that has an agency relationship. Remember, if the parties does not have an agency relationship, agency theory does not establish there. Okay. Then companies manager have personal objectives different to the shareholder. If it is so, then a conflict arises. Okay. And to make sure that you solve that issue, there are some reward schemes. But remember, even with reward scheme, still that could be manipulated. Even through reward schemes, you can encourage to align the goal of both the parties, still it could be manipulated. Then, good corporate governance system should reduce agency cost to an acceptable level. Now, the last part of this is technical article. So for this topic, that is the financial management function, no technical article is available. So, but when it was written in December 2022, but it's your job to every time go and keep checking whether there are any new updates on technical article on your ACCA website. But as for now, there is no technical article on this area. Thank you for watching, and I've finished my part. Section A is over. Do all the questions from section A from your revision kit if you have it, and if you don't have the latest revision kit, do not stress over it. Open your ACCA study hub and please go there and do all the questions. They are the same questions of revision kit only. Same questions. So do it today, and meanwhile, don't forget to subscribe to my channel, and lecture 2 will be coming soon, which will be the section B syllabus. That is the financial management environment. Thank you and take care.